Could 2026 be a banner year for banking? This is Sectors Up Close, and we're talking financials. The financial sector underperformed the wider S&P 500 in 2025, gaining 13.8% on the year. But deregulation, falling interest rates, and the Trump administration's permissive attitude to mergers that might previously have caused antitrust worries means industry insiders are forecasting a strong year for M&A, while near record highs in stocks help drive trading revenue. Tyler Ellegard is president of Gradient Advisors. Tyler, first then, why didn't financials keep up with other stocks last year?
Well, I think the main focus has always been on AI and the companies that are actually picks and shovels in the ground and the technology behind it. And so I think as the focus shifts, we're looking for other ways to be involved and invest in the AI trade. I think financials are a good place to be right now. And I think we get that through M&A and IPO activity as well.
As you say, we saw a beginning of a comeback for M&A and IPOs last year with big deals like the sale of Warner Brothers on the table. What's driving that?
Yeah, look, companies are looking for efficiencies, and you're seeing opportunities out there that are being taken advantage of. And I think that's going to continue, especially with the more focus on the AI side. But as you mentioned, it doesn't necessarily have to always be AI with Warner Bros. And then the IPO activity, we're seeing a few IPOs actually happen today. So I think that activity does continue, but it's more of the opportunities and the efficiencies that companies are trying to gain advantage of right now.
You mentioned deals being driven by the build out of AI. How does investing in financials enable investors to profit from those?
Well, you need financials, you need banks, you need the big money center banks that are actually involved in this type of activity, because in order to have the fund flows that companies need for the build out, they have to go to the banks. And so the banks will benefit from this. And whether it's M&A activity or actual loan growth from companies building the actual data centers, I think financials are a perfect place to be involved in that. And that's how investors are going to gain access to AI through banks is just the loans and the M&A activity that will benefit the earnings of financials.
Does that mean, though, that investors should be worried about banks lending too much to build data center projects that aren't yet profitable?
Yeah, you certainly have to be cautious on which banks you're buying. But from our perspective, we prefer the bigger money center banks that are, they're not solely tied to loan growth and over lending. Sure, there could be an impact if something does happen, but generally speaking, these big money center banks have other diversified portfolios outside of just exposure to AI companies or data center companies that are doing the build out.
What about the loans being made by private credit and private equity? Those, of course, are backed up by borrowing from the major banks, but there's less transparency. And last year, the failure of First Brands Group created a lot of nerves about the risk to financial system from private markets. Should that worry investors?
I think that's more of a one-off case, because that was also some fraud that was happening in there. So I think from the general perspective, yes, there's a lot of focus on private credit, which could continue to fuel this AI growth, and maybe they get some better terms outside of just going to the traditional banks. But generally speaking, I think that's a more one-off type of situation, and I wouldn't be overly concerned, especially with the banks that we're more involved in, whether that's the Goldman Sachs's or the Bank of America's, the Citigroups, right? Those are more broad-based type of banks and not solely focused on those types of situations happening.
So you'd advise stock picking the major banks rather than making a broad bet on the financial sector?
I would, yeah. I would stay towards the larger banks and not necessarily the lower, smaller banks, maybe the regional banks. There's a handful of regionals that you could handpick out of there, but generally speaking, I'd stay towards the larger banks.
In 2023, we saw worries about regional banks. Could those resurface, do you think, this year, particularly as interest rate income will fall as the Fed brings rates down?
I think it's going to be dependent on which bank. So there's so many banks out there that you can invest in, and you have to be picky when you are going into the regional banks or even the smaller banks beyond regionals. So you do have to look at what their loan book looks like when you're investing in those. So I wouldn't say that it's going to be a big issue, but you do have to be cautious of which banks you're investing in if you're going to go the route of regionals or even smaller.
That was Tyler Ellegard of Gradient Advisors. Don't forget, you can watch more videos on Reuters.com.